I'm Sebastian St. James. How long does it take you to double your money in the stock market, and which stock market in particular will you double your money the fastest? In a previous video, one of my viewers said, "Hi, is a hybrid Australia and USA stock portfolio the way to go? What about other stock markets in Europe and Asia?" This is the ASX 200 total return plus franking credits over the last 10.3 years. And this is the S&P 500 total return in Australian dollars, interesting, over the last 35.3 years. Why Australian dollars? In a previous video I asked, would you like to see US indices like the S&P 500 in US dollars on this channel, as all God-fearing, freedom-loving, high fructose corn syrup people would? Or would you like those Yankee Doodles converted to dollary doos so those cobbers who are fair dinkum could have a proper squiz down under? Overwhelmingly, the response is people want things converted to Australian dollars, so convert I shall. This is the Australian versus US hybrid index. Hello, it seems to be missing. Where is it? Oh, there isn't one. So what the viewer's actually asking for does not exist. But fear not, I can create one. General Motors tried to become Australian by creating Holden, and they failed. Starbucks came to Australia to corrupt our coffee culture, and they failed. Could my American-Australian index succeed where hybrids in the past have failed? Here it is. This is the Australian and US equals over 10.3 years. Wow, what is that? Well, it's a brand new index. It doesn't exist anywhere else other than on this channel. And if we zoom in, it is basically 50% the ASX 200 total return with franking credits. In other words, the graph that we normally see, plus this time you got half of the S&P 500 total return, which includes dividends, and they start off 50-50, and then we let them grow based on whatever's happening with the market. Wow, that is impressive. Sometimes I bandy about indexes as if they're readily available and you can just go off and invest in them. Well, you can. So IOZ is an example of how you can invest in the ASX 200, and the IVV is an Australian ETF, and that's an example of how you can invest in the S&P 500. Over that 1 year, the equals returned 3.07%, right? The American index returned 3.67%, which means it's won. And Australia, oh no, dismal at 1.9%. You should hang your head in shame, Australia. Over 2 years. Oh, wow. Okay, this is fun. Very complicated. What do I have here? In orange, which has gone slightly up the top, right, we have the Australian index, which includes franking credits. In red, it's the US index, right? And in blue, we have the equals. Is blue in front? I'd have to check the numbers. Oh yes, look at that. Over the 2 years, the equals is 18%. The US, well, 17.9. I mean, that's incredibly close. Australia, 17.1. They're actually all really close. Oh, well done. Over the 3 years, orange is in front. Who is orange? Well, that's Australia. Oh, well done, Australia. You finally decided to come to the party. And you've returned 58.7%. Yeah, very well done. The equals has returned 48.9%, and the US, is last at 44.3%. Boo! Over 5 years, well, look, it's America's in front. The equals came second, and Australia is down the bottom. So what's that? The equals have returned a CAGR, a compound annual growth rate, of 12.7%, which is actually pretty good. America's returned 14.1%, Australia 10.2%. Those couple of percent there really do matter. Over 10.3 years, which is all our data, well, red, look, you've won, haven't you? That's the US market, and equals are in the middle, exactly in the middle, and Australia is last. Oh, well, I'm sure you had fun trying. So here are the final results. The equals is 309%, pure American was 443%, and a pure Australian was 175%. So we've discovered hybrid actually sits between the other two indices, which is kind of predictable. If you're half American and half Australian, you will sit in the middle. But over the last 10.3 years, you would have been better as far as performance is concerned to go pure US. Now, that is the S&P 500 converted into Australian dollars. So what happens with the currency shifts does actually impact that index in particular. Will that happen in the next 10 years? Well, nobody can say for sure, but we do know the S&P 500 has a very strong return. So does Australia, but the US does tend to do better. The question is, who is the equals half American, half Australian good for? There is a particular type of viewer watching me right now who the equals could in fact be the perfect solution. Those who love Australian stocks. Buy Australian, own Australian stocks. Oh, but if America is actually shown to perform better, doesn't matter. I'm owning Australian shares. I trust them. That could be an opportunity to get into the equals because you're still owning Australian stocks and yet you're getting some of the performance boost of the US. Let's say I'm tempted to spread across both countries. How do I actually achieve this? Well, you have ETFs that focus on Australia, you have ETFs that focus on the US, or you can buy individual shares if you want, and you basically put the same amount of money in both countries, if that's the strategy you're after. The question is there enough uncorrelation between the equals and the Australian and the US stock market? So maybe if one stock market went down, if you owned the equals, you'd actually sail right through. Well, let's see. So the correlation between the equals and the American is 99.9%. Oh, wow. Yes. In other words, no, there's no protection there at all. They're basically exactly the same thing. The correlation between the equals and Australia, including the franking credits, is 99.2%. Yes, exactly the same thing. So this totally makes sense. I mean, they are exactly a blend of the two indices. Of course, they're highly correlated. So protection, the equals is not giving you. Well, if there's no protection, it could actually smooth out your returns, make them more predictable because you're actually broadening the amount of stocks you're investing in. Well, of course, all Australian and all US. Well, let's take a look. What we do is we run the line of best fit, that's those little dotted lines, right through the indices, and we find out which one actually follows that line of best fit most closely, hence smoother returns, hence more predictable. Well, the equals return 97.9%, which is in fact the smoothest. Look, only just, to be honest. But smoother is in fact is. The American stock market returned 97.3%. The predictability of Australia was 95.7% over the last 10.3 years. Look, all three are incredibly predictable, but the equals did win in that particular test. Oh, Shrimp Tanks has just given me a thanks. Aha! I've found out why Shrimp Tanks' question suddenly went right to the top. Yes, I can be bribed. So if you find one of my videos particularly useful like Shrimp Tanks did, hit the thanks button below the video. This is Europe, right? And so is this. This is Europe, TR. TR stands for total return, which means including dividends over the last 10 years, of course. No franking credits outside of Australia, so no franking credits for Europe. That is the S&P, so the Standard & Poor's, Europe 350. 350 refers to the number of stocks in that particular index. In euros, oh no, that's not very useful. Here I've been saying, I'm going to convert things from US dollars into Australian dollars, and suddenly he's doing graphs in euros. So how can I convert that to dollary dues? Well, this is the Australian versus US dollar over the last 19.4 years. Wow, that is useful data. Look how sharp that graph is. Yeah, okay, it's very telling. This graph shows you one Australian dollar converted to euros. Fortunately, I can do the currency conversion, so you don't have to. So we go from this, which is in euros, to now this. Oh, how exciting, which is in Australian dollars. Suddenly, it's all making sense. The astute amongst you will notice there's a little extra in the description. What is that? Oh, I've given examples of ETFs. So this particular Europe index is available on the ASX in the stock code IEU. Well, that's useful to know. This is Europe in Australian dollars versus America in Australian dollars versus, well, Australian in Australian dollars, obviously, including total returns and franking credits. Blue is in the top. Who is blue? Blue is Europe. Aha! Oh la la! So, you actually win over the 1 year. America comes second and Australia is last. Oh. The ETFs are IVV and SPY, and Australia and the ETFs for that is IOZ and STW. Well, what did they return? Europe returned 15.5%. Look at that. That is like the runaway winner. Not just slightly, that's just incredible. America returned 3.67%, Australia 1.9%. Why did you bother showing up, Australia? Over 3 years. Well, orange is in front. Orange is Australia. Oh, lovely. Well done. America is second. Europe suddenly goes down the bottom. Isn't that interesting how quickly they swap? 2 years in between the two graphs, and suddenly they've all reversed. So Europe returned 41.7%. America returned 44.3%. Well, they're pretty close. Australia, 58.7%. Definitely the runaway leader. And a CAGR of 16.7%. Nobody would say no to that. Over the last 5 years, America's in front. They're all over the place here. Australia is second, Europe is down the bottom. Yes. So Europe has returned a CAGR of 8.02%, the US 14.1%, that's very impressive, and Australia at home 10.2%. Over the last 10 years, which is all our data, well, America has won blue. Oh, that's Europe has come second. Oh no, Australia's come last. Oh well, I'm sure you tried hard. So here are the total results for all the data. Europe, 187%. America, 392%. Yeah, there's a big difference there, isn't there? And Australia, 154%. Now to the question I asked at the top of the video. How long would it take you to double your money in each of these three markets? Well, let's find out. In Europe, converted to Australian dollars, 6.6 years. Okay. If you pop that in America, it would be 4.4 years, based on this historical data, and in Australia, 7.4 years. That's massive. That's almost double what the American took over this time period. That data is quite revealing. Oh, this is Poppy, and Poppy's my brand new channel member. Poppy has a passion that nobody knows about. Should we have a sticky peek? Poppy loves status quo. Down, down, which was recorded in 1974. Wow, that is interesting. Poppy's secret has been revealed, but what I can tell you, growing up, my brother played status quo basically non-stop. So I basically know all the songs, whether I wanted to or not. But lately I've discovered that the status quo members have contracted a hideous disease that caused their guitars to swell up. Take a look. Oh yes, I can see that. That's very disfiguring. I hope they got that scene too. So Poppy, thank you very much and good luck listening to Status Quo. And if you'd like to become one of my channel members and get all the perks that Poppy's getting right now, hit the join button below this video. Although Europe in our data set actually did not outperform, maybe it is more stable over time and stability can be important. So we draw our line of best fits. Right, based on that, I can hardly see. To be honest, based on that it looks like America is less stable, but let's have a look at the actual data. Well, Europe, the predictability was 90%. In other words, that was less stable of the three, not more stable. Interesting. America was 97.6%, which is the most stable. Australia was in second place at 95.5%. Look, they're all incredibly stable, but it's interesting that Europe is lagging behind in stability based on that data set. The question is Europe far enough removed from Australia and the US that you'd actually get a level of protection, a bit of uncorrelation going on? The correlation between Europe and the US is 97.1%, in other words, highly correlated. And between Europe and Australia, 97.2%, highly correlated again. Wow. So diversify by all means, but you're not going to get any downside protection if one of those markets crashes. That just leaves Asia to go, which Shrimp Tank asked about. But Shrimp Tank has actually asked me more questions. I think they're methodically going through every region in the entire world. Dare I ask about Africa and South American markets? Well, look, you've dared. There it is in writing. Seeing that we're going to come back and look at a few more regions, we'll leave Asia to that video. If you're considering buying property, don't until you watch this video, which is very revealing. Click here to see the video, or if you've seen that, click here.